The Enron scandal remains one of the most significant corporate collapses in American history. Let's look at what went wrong. At its heart, the collapse was driven by massive, systemic accounting fraud designed to hide billions of dollars in debt. When the truth finally surfaced, shareholders lost roughly $74 billion in value, and thousands of workers saw their retirement accounts vanish. Enron used complex shell companies to hide debt and recorded long-term project revenue before they actually earned the cash. Standard accounting rules, or GAAP, require full disclosure. Enron bypassed these rules, creating a false image of profitability. As confidence eroded throughout 2001, the stock price collapsed, reflecting the reality that the company was fundamentally insolvent. The primary takeaway for investors is that transparency is essential. If a company's financial statements seem too good to be true, they often are. Thanks for watching. Always research the companies you follow. Like and subscribe for more basics on how markets function safely.